Greetings, everybody. It's Craig Smyser with 1835 Realty. Wanted to give you some more information about kind of what's going on in the market today. And I have asked Michael.Scott with Capstar Lending to join us. He's going to give us some insight as to what is changing in the lending world. So Michael, welcome. Glad to have you with us.
Craig, thanks for inviting us.
You bet. So before I start asking Michael some questions, I just want to set the stage about what real estate is doing here in the Austin area. I've been tracking the numbers very closely since we started in on the coronavirus situation. And what we're seeing is that the number of listings has been, new listings coming to the market has been dropping. And right now, when you compare to year ago numbers, we're off around 40%. So 40% fewer listings coming to the market. Now, then we got to look at the contracts that are being written. And again, the number of contracts that are being written has again been declining, and they are off really about 36, 37% from where they were a year ago. So those numbers are getting to be fairly similar. But there are still, you can tell, there's still a lot of buyers out in the market. There's still a lot of sellers out there. And so that's the kind of market we find ourselves in. And I expect, I'd originally said at the beginning of May, we would really start to see both the number of listings and the buyers out and about start to increase. Then last week, I thought, I think it's going to be a little sooner than that. But then the lending has to come into play. There's been a lot of changes in lending. So Michael, if there are buyers and sellers that are going to be entering the market over the next, say 2, 3, 4 weeks from now, what's changing in the lending world that is important?
Well, it's more about what's, not changing. Pretty much everything is changing and tweaking almost hourly, it seems like, Craig. There's been a lot of dislocation that's occurring in the marketplace. We're seeing two major trends, which is, there's been a knee-jerk reaction in terms of credit tightening, particularly, just guideline changes being implemented throughout the spectrum by the large originators, what we call the aggregators of the world, Chase, Wells, PennyMac. We're not seeing guideline changes at the global level by Fannie Mae and Freddie Mac. They are kind of leaving it up right now to the marketplace to determine how we're going to tighten. But we've seen across the board an immediate reaction of credit tightening, which is the first step. There's two things. There's what's occurred primarily in terms of why is that occurring is with the CARE Act that was recently passed in Congress, which was really the needed stimulus package. And in that package, they talk about they have allowed mortgage borrowers to ask for what's called forbearance from their mortgage servicer. They did not, forbearance is not forgiveness. Forbearance is simply, may I delay my obligations for 3, 6, or 12 months. And at that point, the forbearance period ends, and I'm required to pay back that forbearance amount, whether it's in a lump sum or over 6 months or 12 months, or possibly added on to the back of the loan. But I have to pay it back. I have to start paying it back. Well, what's occurred there in the industry, okay, is Fannie Mae and Freddie Mac will not buy a loan from a lender where the consumer has asked for forbearance. So there's a little bit of a catch-22 occurring right here where, like Capstar, which is one of the larger companies here in Austin, we sell to about 6 of the large national lenders, okay? And if we sell a loan where we've closed the loan and 2 weeks later that consumer comes to Capstar and says, hey guys, lost my job, I need forbearance. If we accept that loan is a non-sellable loan and can't come off the books, exposing Capstar to significant risk. So everyone, of course, in the rush to mitigate their risk is implementing guidelines, particularly as it relates to continuity of income, what type of job you have, additional reserves, additional FICO scores, higher scores, anything that's a credit quality variable, they've tightened in
Okay.
order for the lender to reduce their risk.
All right, so let's take a typical buyer in the Austin area buying a home, say between $400,000 and $600,000. What kind of credit score did they need a few months ago versus what's needed today? What kind of reserves did they need a few months ago and what's needed today?
That typical buyer, if he was putting 20% down, could have had as low as a 680 or a 660 score. They really didn't have to have pristine credit with 20% down. The reserve factor, frankly, was probably only a couple of months that would be required on top of that 20% variable. Today, that credit grid now is minimum of 720. You don't have to put down 20%, okay? But what we're seeing across the board again is that implementation of additional reserves anywhere from 6 months to 12 months, depending on the nature of the employment. We've had some lenders, if you are self-employed, have imposed a 12 months of liquid reserves requirement for that client. So now that's on the high end, but in general, about 6 months. So the buyer today, while in your price point that you mentioned, really that buyer in Austin, Texas, has been above those standards for the most part. But again, everyone now has to meet those standards.
All right. So what other aspects are you seeing overall that are changing?
We're seeing a scrutiny of the type of employment. If you are in a job that's considered essential, government job, teacher job, healthcare, we feel the lenders feel more comfortable about the continuity of income, the likelihood that you're not going to be impacted with a furlough or a job loss. If you are self-employed, we'll use a physical therapist as an example, right? You're not meeting with clients, and that buyer probably is not getting a loan at this point because he can't prove the continuity of income. Again, it's a scrutiny of because everyone's going to question on the back end of after selling loans, was that buyer going into forbearance immediately and going to need a break, or were they able to weather the storm? So those types of jobs are unfortunately at this point are probably being paused from the buying cycle.
Okay. And so we mentioned, if you're self-employed that way, normally a self-employed person needs to show their last tax return, maybe their last 2 tax returns. So what would someone have to do now? Just show some bank statements that shows the income is coming in? Is that basically what the factor might be?
Yeah, essentially. So you're still living with the normal guidelines, which really are going to be 2 years of tax returns, whereas in the past, you might have gotten away with 1 year or a year and a half. Today, it's an absolute 2 year. And because we've had the extension of the IRS deadline for filing taxes, most self-employed businesses have not filed their 2019. And so you're a year and a half into a cycle without a tax return. So lenders are really scrutinizing, bank balance statements, CPA letters, all of that. And again, the nature of that self-employed business. If you're a public relations consultant working with, let's say, down at the Texas legislature with lobbyists, if you've been doing it for 3 years and you have contracts in place, then you're going to be fine. If you are a real estate investor with 8 VRBO properties, you're probably out of luck right now.
Yeah. Okay. So let's talk a bit in terms about what a buyer and seller should be aware of in this current climate, and of course, as an agent, what I need to guide mine on. So I've got a buyer who's interested in looking at homes, right? Mm-hmm. Obviously, I'm just going to preface it just once that everything is going to be done under the norms of what we need for COVID, digitally looking first, working appropriate, masks and gloves when we actually look at homes. So presuming all that's done correctly, what should a buyer do more than just they should have done a couple of months ago? How should the buyer get prepared with you?
It hasn't changed, that dramatically. They need to go in, probably letting us know where everything is, as opposed to, I've got the down payment over at this resource. You don't need to see the rest of my business. At this point, it's critical, just like we talked about with reserves, to substantiate, additional reserves in order to weather what could be a storm. It's important to really have a reasonable understanding of where we are. I mean, an example was a young man just in a situation where they really weren't employed for that two-year period, and they're just going to have to find a different outlet, which might be a portfolio lender, a local community bank that can do it, because that lending is still allowed. But what you and I have been talking about primarily is the secondary market, the lower rates with the cookie cutter qualifications. The buyer needs to see a little bit, and on the realtor side, the length of time for the transaction has extended a little bit. I would say we've been impacted from 10 days to 2 weeks. Not overly dramatic, but what's being required of lenders now is a full underwrite all the way up. The underwriter approves the file, and there's essentially a re-verification process that's occurring in the last 5 days that is making us start over in order to ensure ourselves that the buyer has not had a modification in income, a modification in employment, been furloughed. All of those re-verifications, which used to occur maybe 10 days to 2 weeks almost before the transaction closed, are now occurring 3 days before. So which is impacting, staffs throughout the country for lenders and slowing down the process just a bit.
So what normally we used to always say, 30-day close is fairly typical. We should now be readjusting that to, with a property or with a purchase that has a mortgage, to be more in the 40 to 45 day
yes
frame.
Absolutely. Right. Simply because of the tail chasing that's occurring at the end of the process, and in addition, the coordination really even at the escrow closing table with the title agents, because we're finding some consumers don't want to go into offices, some want to do remote mobile notaries, and so there's a little bit of play there that's taking some additional time to take care of.
Yeah, and I even understand just the basics of employment verification, because everybody's working from home. That employment verification is now seeming, in some cases, taking quite a bit of time to track down that employment verification as well.
Right. And just to give you an example, all lenders, if they're originating toward the Fannie and Freddie standards, it's essentially there's a re-verification, a verbal verification within 3 days of that note. Okay, so if I've got I'm scheduled to close on Friday and it's Tuesday, I need to verify now, Tuesday, Wednesday, Thursday, before that loan closing, that they're employed. And just like you mentioned with the remote issues, we had a military person, in the Navy, and we were having the hardest time getting hold of their supervisor because no one's in the office. And so those delays are creating some issues at certain points.
Okay. And then, so in short, from a buyer's side, it's going to take longer and it's going to be more invasive than it has been. We got to, get a much clearer picture earlier on in the process. So
we're seeing some decreases in the maximum debt to incomes. Not seeing that across the board yet. Typically, we could go as high as 50%. We're seeing some lenders ratchet that down to 45. Some lenders ratchet that down to 43% on the high end, again, depending on the level of reserve. So a little bit of that credit qualifying window narrowing just a bit.
Okay. So turning then to the seller side, if you've got, a seller receives an offer and it's got a pre-approval letter, usually the agent, I would call, chat with the lender, just kind of ask some questions for which they were, able to answer. They can't answer all of them, and see how it is. Nowadays, of course, got to be a lot more invasive, I think, representing a seller, because not all lenders are going to be as knowledgeable as you are and keeping up to speed with what's going on. So you got to find out, does the lender know about these changes that are going on? Have they been asking the right questions to that buyer? And, one of the things I occasionally see in our typical market is that a seller wants their lender, or the agent truly wants their lender to have a conversation. And a lot of people are reluctant to that, but I think we're going to see that popping up more, that agents want to know that this buyer has been properly vetted, don't want to find out 2, 3, 4 weeks into this transaction that it was something that a knowledgeable lender would have known up front is not a qualified buyer.
Right. Yeah, certainly I think that's going to pose some issues during the process. Yeah, because things are changing so dramatically. Some smaller, whether a small lender or a large lender, you're dealing with a loan officer who might not be being communicated with all the changes, and may not even realize that 3 weeks from now, when they submit that file into underwriting, that buyer no longer qualifies. So the experience and knowledge that those individual loan officers are keeping abreast of the changes, yeah, it's going to be critical. And even saying that, okay, you can see a situation where you think you're fully qualified today, and the market is so fluid in terms of qualifying that 3 weeks from now, you might have seen just a response by all lenders to tighten things immediately that now makes your buyer non-qualified. So that's going to occur, not a lot, but it's going to occur in some instances.
Okay. So is there a point that a change like that doesn't affect buyers in the process? Like, for example, the buyer has been submitted to underwriting and then the rules change, or is it, hey, as long as they haven't closed, we're going to subject them to whatever comes down the line?
Depends on how that lender handles what we typically refer to as the lock process in the industry. So many lenders like Capstar have gone from a process where, think of it as we put people in just a large pool, and we're just processing loans under normal standard guidelines with no designation toward the end investor. And we don't designate that consumer until they've closed, and then we sell the loan. That process is changing pretty quickly at the ground level by lenders, to where many of us now are designating that loan from the very get-go. We're locking the loan with a specific investor under specific guidelines. So what you do see at that point is the lender that you've locked in will not modify those guidelines on the prior lock. They'll accept that. And there are some exceptions to that, but for the most part, they're going to live with their guidelines that were in effect at the time that the consumer is committed to that loan, and you're okay.
All right, so we've talked about kind of this typical buyer in the 400 to 600 range in the Austin area. Let's talk a bit about a little bit under that, typically an FHA loan. How has the FHA loan process changed recently?
The dislocation there is, it may have even been a little more severe. I mean, there has been a backing away by buyers of FHA and VA product in a pretty dramatic way over the last month. So the industry's trying to find its balance. We're seeing, whereas in the past you might have had a lower credit tier buyer that had some issues in the past, that might have had a 620 or a 640 credit score. Those have ratcheted straight up to about 680. We're seeing, and in the past, you might not have had to have any reserves, and now you're seeing 2 months to 6 months reserves, depending on the lender, on the FHA side. You're also seeing, whereas you're seeing now a requirement to be on the job 6 months to 12 months, depending on the lender. If you're an hourly employee, they want to, there's a scrutiny of that continuity of income, all due to the risk of credit delinquencies occurring down the line and an ultimate loss by the lender on the loan. So yeah, definitely a tightening for that.
Okay, so let's jump then to the other side of the spectrum with jumbo loans. How has that changed?
Maybe even more dramatic than the FHA side of things. We have seen a pulling away by national lenders of purchasing jumbo product from independent mortgage companies such as ours. Now, whether you're a bank or an independent mortgage company, if I was selling to a couple of the large national lenders, they have now ceased buying from us. They're still making jumbo loans. They have not stopped making jumbo loans in the marketplace, but there's no longer a channel where lenders would utilize them as a takeout. So you're having to go directly, for the most part. Now, Capstar's got some great relationships with some smaller community banks that we've set up relationships with. So we've kept that pipeline going along, but the national guys now have been removed. At the national level, they have again tightened up. You're seeing, whereas they might have done stuff above 80%, it's 80%. FICOs are 720. We're seeing a reduction of cash out jumbo loans we're seeing an elimination of investor jumbo loans. So definitely a tightening up. We're seeing DTIs. We're hearing of DTIs. We heard of, now this was a little bit of a rumor, but we heard of one national lender basically requiring on the jumbo side that the client deposit $250,000 with them before they make the loan. Now that's on the crazy side a little bit, yeah. but it's difficult for that jumbo buyer. He really needs to do his due diligence up front. Pick the guy that he feels very comfortable with, and the agents are needed to follow up with those lenders to make sure there really is a takeout with those jumbo buyers.
Yeah, and so, I guess overall, what I would just express to folks who are watching this is that, as you can tell, experience really matters. You need to be working with an agent who has been through ups and downs in the market before, with a lender who's been through the ups and downs, who is staying current on things and asking the right questions up front, so that we can greatly reduce the risk of not being able to close further down the line. Now, I also, we talked, this has all been about purchases, which is what I'm involved with. But of course, you have two aspects to it, both purchase and the refinancing. So just share a bit about refinancing, because rates are so low. Even if you're not planning to move, you should be thinking about refinancing. So Michael, just kind of address that, how the refinancing game maybe has changed as well, and who should be thinking about refinancing right now if they haven't done it already.
Yeah, it certainly has changed. It's impacted just as highly as the purchase market is. So those credit standards have tightened for them as well. So we are seeing many people were taking advantage of before the crisis hit of cash out, as an example, and that's now limited. Investors were coming back and regurgitating, dropping rates and pulling cash out of some of their investment properties, and that's now seriously been deterred by the new lending standards. What you're also seeing again in the mortgage space is, because it's really a risk-off trade right now, where lenders can make a loan today. They can make a loan today, and if that consumer it's a perfect loan. But if that consumer is impacted 3 months from now with a job layoff situation, that consumer asks for forbearance from their servicer. And if there's a hiccup in the forbearance repayment, or if the other lender decides that forbearance is considered an early payment default, the original lender, whether that's a Capstar or a national bank, is then asked to repurchase that loan. So that repurchase risk, that liability risk, is such that many lenders are simply stepping back. They're simply stepping back and saying, I need to reduce the amount of loans I'm making, and when I make one, it needs to be perfect, simply purely from the liability standpoint. Yeah. So while the rates are great, that consumer we're basically handpicking them somewhat, or that you're seeing that the borrower has additional, substantial reserves. They're going to weather this storm, and there's not going to be any issues.
All right. Excellent. Well, I think I've kind of run through the questions I had for you. Anything else that you wanted to address that I didn't ask about?
No, I mean, I am curious a little bit, Craig. Are you seeing, like the COVID amendments that, Trek added? Are you seeing that in most contracts, 50%? I mean, because, frankly, from our perspective, there is a great deal of risk for that buyer. And, many times, there was a large employer the other day in Austin that basically furloughed, a substantial number of people that you would have probably not seen that coming in this environment. So just curious what you're seeing on that.
Well, it depends, right? Because with this addendum to it, if I represent a buyer, that is very beneficial, right? Gives a great way to get out of the deal. If I represent a seller, again, it gives an easy way out. So it really depends. I personally have not been seeing it used a lot, but I know talking with other agents that it's extremely routine and part of it. But again, it depends on which side of the transaction you're on as to whether or not it's beneficial. Much more beneficial from a buyer to have that included because of their ability to stretch out the transaction or get their earnest money back.
One other thing, Craig, before we leave here, that we'd be remiss in not talking about the appraisal aspect of what's going on the business. So an interesting thing, at least in the Austin market, is there was some loosening a little bit, frankly, of the type of appraisal you could do, where the lender was allowed initially to do what's called a drive-by, where they don't have to go inside the home, given the COVID issues. But what we've seen in the last 10 days to 2 weeks is we've seen some lenders that are now backing away and not allowing that. Now, the good news is, because I went through our entire pipeline at Capstar to see if we were being impacted at all with some restrictions that are being placed. What we found is our appraisal board were essentially 100% of the time not utilizing the exterior option, and they're still able to go in. People are still allowing them access to properties. They may be being protective, opening doors for them. So that process really hasn't been impacted too bad there. So I would tell agents to be open to letting the appraiser into that home. Don't just say, hey, can you do an exterior? Because that might impact you on the lending side. And then, and again, at this point, we've not seen any impact on values because it's too early in the cycle. So at this point.
Well, good. Well, if someone's interested in contacting you about refis or purchases, what's the best way to get a hold of you?
Sure. Would welcome a chance to see if we can help. The office number is 512-459-2419, or my mobile is 512-289-8783, or you can reach me at Michael.Scott at capstarlending.com. And welcome a chance.
Excellent. And I'll put that in the comments as well. So hopefully, I know this was kind of a long interview with Michael. And for those of you who watched the whole thing, thank you for doing so. Important information for people who are in the market now or contemplating getting in the market soon, both buyers and sellers. This is just one of these things that you've got to understand what's going on and have a clear picture of the buyer before we get involved in a contract these days. So thanks very much, Michael. And as things change, we may have you back to update us some more.
Would welcome the chance.
All right. Thanks very much.
Thank you.
Bye.